In the earlier days, it was simple to say, pure exclusion. I don't want this, I don't want that, this, I don't want that. The risk is that that puts assets into hands of people who don't care as much, frankly. And so the last thing you want is high impact industries being in the hands of people who are not stewarding the company in the way that you might want. The other point is that to effect change around, for example, power and energy, you need sizable companies, frankly, with sizable balance sheets, with sizable cash flow generation ability to invest that capital into clean energy. And so whilst it's tempting to say, I invest in this sort of 100 megawatt, 1 gigawatt solar farm in X country, what you really need to do is deploy capital on a utility scale, move the needle in that kind of scale. And so that requires quite thoughtful and careful ownership of these companies. It requires you to work with management to look at sort of very long-term strategy around capital deployment over the next 10 years, to do that in a way that ensures a just transition, which is what Daniel mentioned. And then also, from an investor's perspective, and we put aside the environmental positives, which I spoke about, from an investor's perspective, we think there's a very interesting transition alpha that I mentioned earlier, where you can work with these companies who are not necessarily loved by all the market, and certainly there's some exclusion strategies that are out there in the market, and invest in them as they transition, as that perception changes, as that energy mix or power mix changes. Then we think there's potentially a valuation angle there, and certainly some of the data that's out there and the analysis out there would tend to support that in some regions. So it's much harder to do. There's a temptation to simply exclude, but we think that there's risks to the environmental angle, but also leaving alpha on the table from an investment perspective as well.